All right, it is 1 o'clock now, so we will go ahead and get started. So welcome everyone to the BARS update for GAAP government. My name is Kaylee Paggio, and with me today is Christy Kogel and Olivia Crouch. We're all on the local government support team here at the State Auditor's Office, and we're here today to give you all of the exciting updates coming to the BARS Manual. We did send out an email yesterday afternoon with the handout for today's presentation. We do apologize, we had some issues with Outlook, so we apologize if you didn't get it in advance. If you do still need it, you should be able to access it from your GoToWebinar control panel with the header titled Handouts. And if you have any issue getting the handout, definitely let us know and we will get that emailed out to you. And before we get into the really fun stuff, I just need to go over a couple webinar housekeeping items. So we encourage everyone to ask questions throughout the presentation. And this is just a screenshot of where to input your questions. On your GoToWebinar control panel, you should see the header for questions. You can click that icon in the top right to open the box and enlarges it, so it's easier to see and type out those questions. We do have a full agenda today, so if we're not able to get to your question during the webinar, we will definitely reach out afterwards and get you a response. If for some reason some questions may be unique or require additional research, then we may refer you to the help desk and then we can work with you on that question outside of the webinar. And then we have 8 polling questions that will be displayed randomly throughout the presentation. These are not required and do not go towards CPE credits. These are just a fun way for us to gather information and help keep everyone engaged throughout this 2-hour virtual webinar. And with that, let's go ahead and do our first polling question so you can see how this is going to work. So you should see it up on your screen now. The question is, how often do you visit the BARS Manual? So you can input your questions. We usually leave this open very briefly, like 30 seconds. So give everyone a couple more seconds to get their responses in. And then we'll go ahead and close that poll. And what's fun about these is we can share the results. So you can all see how everyone else voted and what the majority of people are saying. So tied for monthly and quarterly, so that's awesome. And then we will talk about the CPE tracking. So this webinar is 2 hours and eligible for 2 CPE credits. There will be 8 code words displayed throughout the presentation, so that's 4 per hour. These code words are used to get your CPE credit. So these are the important ones if you want CPE. It is up to you to keep track and document the code words in the order that they are presented. So when the webinar ends, you'll be asked 8 questions related to the order of the code words, and the correct responses are required to get the full CPE credits. If you miss a code word, we unfortunately aren't able to provide it to you after it's been displayed. The rules around CPE credits and how they're tracked is very strict, so we're just trying to abide by those rules and making sure everyone is aware and that they need to keep track of those code words. And then once the webinar has ended, the survey will pop up in a separate window. There are 2 questions related to the BARS update. They just ask one thing that went well and maybe one thing that could be improved on for next year. Then those 8 questions about the code words. So want to make sure to answer those in order to get the full CPE credits. And then automatically you'll receive the certificate of attendance within 24 hours. Keep this. This is used in conjunction with the CPE certificate, which gets sent out separately by SAO within about 4 to 6 weeks. And here is a list of our agenda items for today. We have some great topics to go over with you. The first hour is going to be dedicated to just the general BARS updates. Then the second hour will be dedicated to leases and SPIDA only. So if you have already attended the lease and SPIDA training, or this topic doesn't apply to you, you are able to leave the webinar after the first hour. Just a disclaimer though, that if you do that, you will only be eligible for 1 CPE credit. And with that, we have our first code word, and then I'm going to hand it off to Christy to get us started with our first agenda item. And the first code word is BARS. So make sure to document that. First code word is BARS.
All right, our first section is accounting for courts. With the implementation of GAAP 84, we really, as an office, started looking at the accounting for court services, and we worked with the administrative office of the courts to determine if we were meeting all of their requirements for courts. We did notice that we were missing one section of courts, so we will be changing some items with the municipal courts, and that is code 51250 will be removed and replaced with 2 different codes. One is 51251, which is our non-contracted court. This is if you are a city providing your own court services. The second code is 51252, which is contracted court. This is if you are a city providing court, or county providing court services to a city, or if you are the city contracting out your court services to another government. There is a chance that some of our cities will report both codes. If they provide their own court services, that portion of their expenses would be under 51251. And if they contract their services to another city, those expenses related to the other city would be 51252. This is applicable for fiscal year 2022, reported in 2023. Moving on from court accounting, let's discuss some fiduciary fund items. Nothing is changing. We are just reminding people about the allowable BARS codes in fiduciary funds. So first off, in the past couple of years, when we talk about fiduciary funds, we've been specifically talking about custodial funds. Right now, we are talking about all types of fiduciary funds. So anything in that 600 fund type for your annual report. First, let's start with beginning and ending net position. Under most circumstances, your net position in a fiduciary fund would fall under the 308-508-19 codes, which are our restricted net position. This is because fiduciary funds are controlled by an external entity. Therefore, they fall under restricted classification. In the rare circumstances that you need to report negative balance in your fiduciary funds, this should be very, very rare, you would use unrestricted, which is the 30889 and 50889. So that's our beginning and ending net position. We move on to the 386-586 codes. These are for our courts that are recognized by the administrative office of the courts. This is when you collect monies and then remit them to AOC. There's very specific requirements for these codes so that the Administrative Office of the Courts can allocate items out correctly per state law. If you have a court that remits to the Administrative Office of the Courts, you must have a 600 fund and you must use the 386-586 codes. Next, we have our 38810 and our 58810, which is our prior period adjustments due to error. We also have our 38850 and our 58850, which is our changes in accounting principle. This is if you are changing from one generally accepted accounting principle to another, or if GASB releases a statement that affects how you report in your fiduciary funds. Next, we have 38930 and 58930, which is our custodial type collections and remittances. This is if you are just collecting to remit to another entity. Our biggest examples here are the state portion of taxes, in particular sales tax and leasehold tax. We also see the state portion of building permit fees fall under this BARS code. 38940 and 58940 sound similar to the previous code, but they're slightly different. These are custodial type deposits and disbursements. This is when you are acting as a treasurer for a other entity. Two examples that we see this most often is if a government has a fiduciary pension, so it falls under a trusted pension plan, and they are acting as the treasurer for that pension. Those transactions for the pension plan would fall under the 38940 and the 58940. The other one is our counties acting as treasurer for the special purpose districts. For those funds that receive interest as fiduciary funds, there is a very specific code for interest. Please don't use the standard code for interest. For fiduciary, it needs to be in that 38960 or 58960 code, which is custodial type interest earnings. So let's launch our second polling question. And the question is, how often do you download an updated chart of accounts? All right, just a bit more time here. All right, closing that poll now. And let's show the results. So it looks like most people download at the beginning of the year or when there is a BARS alert. This is what we have been hearing for a while on this. Best time is really at the end of the year or when there's a BARS alert, because that is when we are making changes to that chart of accounts. So I am going to pass it off to Kaylee to discuss the schedule of expenditures of federal awards.
Thank you. All right, so let's talk about just a couple really minor changes coming your way related to the Schedule 16, or also referred to as the CFA. So this probably isn't news anymore, but just a reminder that the term CFDA has gone away and has been replaced with ALN, which stands for Assistance Listing Number. So you will notice that change throughout the BARS manual and within the annual report itself. Now, the numbering system is not changing. You still go to the same place to find those award numbers. It's just the term CFDA has changed to ALN. And then we have also cleaned up our instructions and programming related to how the other award ID number is reported on the CFA, just so that it's more clear and consistent. So previously, the other award ID field was required for every line item on the CFA. So you had to put at least something into that field in order to submit your report. But the other award ID number is actually only required for indirect federal awards. If it's a direct award, then you do not report the other award ID number. So that field should be left completely blank for direct awards. So the other award ID field is only required for indirect awards. Now, occasionally there are some indirect awards that don't have an other award ID number assigned to it via the contract or agreement. And in those cases, you can input NA for not applicable into that field, since for indirect awards, at least something is still required in that field. And just a reminder on preparing the CFA, for direct awards, make sure that nothing is inputted into the pass-through agency field. Even if there is a like NA or none, or even just a couple of commas, if there's something in that field, it's going to recognize it as an indirect award. So if it's direct, make sure to leave that field blank. And with this update, we do have 2 new red flags that you could potentially receive. So one is that if an other award ID number is reported for a direct award, that would result in a red flag. And then also, if there's no other award ID reported for an indirect award, you would also receive a red flag for that. And let's look at just a quick example to just visualize what all of this means. So the top image is just a screenshot of the manual input for the CFA in the filing system. And if you are adding your line items manually, if you leave the pass-through agency field blank for direct awards, the other award ID field just gets grayed out. So it prevents you from inputting something in there incorrectly and helps minimize the potential of receiving one of those red flags. Then the second image is a screenshot of the CFA template, just focusing on the other award ID column. You can see highlighted green in row 2. This indicates that this is good to go. This wouldn't receive any errors when uploaded into the system because we clearly have an indirect award and we have the other award ID reported. Now, the other 2 examples show that there is a pass-through agency name, but there's no other award ID reported. So that would be incorrect since this is an indirect award. And then the last one, you can see that there's no pass-through agency name, but there's the other award ID number. And again, that wouldn't be correct if it was a direct award. The field for other award ID should be left completely blank. So that's it for the CFA, so nothing too crazy. And now we're just going to get into some other annual report updates and reminders. So of course, I just want to put out there the deadline for the 2022 annual report is due by Tuesday, May 30th. So get started early and make sure to allow plenty of time for questions. And that is the deadline for our calendar year-end governments. And one nice exciting update is that we have removed the Schedule 19 for your 2022 annual report. So you won't see that in there. It is no longer a requirement. So that is nice. One less thing you have to do going forward. And that brings us to our second code word, which is leases. So again, that second code word is leases. Make sure to jot that down if you're tracking for CPE. All right. Now, this update is related to the Schedule 20, and that's only applicable for rural counties. So this update was requested by the legislature to improve and streamline how we are collecting this data. Since this probably only applies to a very small number of attendees today, I won't go into much detail. Just know that if this does apply to you, I'm working on a 30-minute training to distribute to counties that this applies to, and that will walk you through all of the changes and how to use the new template and everything, what it looks like. So just keep an eye out for that. It'll come out in the next couple weeks. And then these are just some reminders about some resources and training that are available to you. So this is, so the live annual report training webinars, these are going to be offered in March and April. We do still offer the one-on-one appointment workshops, and those will be the last 2 weeks of April. So those are some training opportunities if you'd like more assistance with the annual report. Registration will open for those in February, so keep an eye out for that. And then just one last thing on this topic is a reminder about the online filing flag descriptions guide, which is located on our BARS reporting templates page. This is a great resource to have open while you're filing your annual report. This goes over all the red and yellow flags that you may come across, and it helps give you tips and tricks on how to resolve those. So it's a great resource to have open. And then this is just a screenshot of where you can find our training and workshops information. And this is under the BARS and annual filing tab on our home page. So this includes our whole e-learning library. So that's all of our recorded trainings will get posted here, and you can access those whenever it's convenient for you. And then we also have a 50-minute introduction to BARS on here. And it's just a great video to watch if you're new, and it helps navigate through the BARS manual. And then all of our information and registration for trainings can be found here as well. The only thing that's not here is information about our all-day BARS training, which is our overview of BARS. And that is put on by WFOA. So we did include a link to their website so that you can keep an eye out for those BARS classes and get registered for those if you are new and need a more in-depth BARS training. All right, and then I am really excited to announce that we are in the process of building a brand new online filing system that's going to have a new look, a new feel, and a much better user experience. I am well aware of some pain points in the current filing system, so I'm really excited with the team that we have working on this. They're working very hard to create a great system that is going to work for all local governments. I don't have a lot of details at the moment, so just stay tuned. More details will be coming out next year. And also don't panic though, this system is not going live in 2023, so you won't have to learn a new filing system in the next couple months. And then we have our third polling question, and that is up on your screen now. The question is, did you know the most important page in BARS right after the update is the alerts and changes page? And if you didn't know, that's okay, now you do. So make sure to check out that page in December when we publish all of the updates in writing, and everything goes into effect in the BARS manual. All right, and then we'll go ahead and close that poll and just share the results. So you can see about tied, yes, and that you didn't know, but you were definitely going to check it out in December. All right, now we are moving on to updates and reminders related to BARS codes specifically. The first one that we are going to talk about is the transportation BARS codes. So the change here is that we have restricted these codes to governmental funds only. So that means that transportation codes are no longer allowed in enterprise or internal service funds. Now, there are 4 exceptions to that rule, which you can see on your screen and also listed in your handout. So those 4 exceptions are still allowed in enterprise and internal service funds. And just give you some background on why this change occurred is we conducted research to determine when or if it would be allowable to report transportation activities in a proprietary fund. And based on that research, we were able to determine that other than the 4 exceptions, transportation activity really is a governmental activity and shouldn't be reported in proprietary funds. So that change is effective for your 2022 annual report. And then just some minor changes is that we went through the entire chart of accounts and added descriptions for codes that did not have one. And then we also updated ones that were a little on the vague side and didn't have very good descriptions. So updated those, and hopefully that helps make that chart of accounts download even more useful to you. And just super quick on this is that we wanted to remind governments who collect special assessment revenue to ensure that you're using the correct codes. And that would be 36850 for those general special assessments. And if you're collecting the special assessments for specific capital projects, then we do have a separate code, which is 36810. So that ends my little part, and now I'm going to pass it off to Christy to continue on with our BARS coding updates.
Thank you, Kaylee. So let's start with 51861, which is our judgments and settlements. If you attended last year's BARS update, you heard us speak on this code. That time, we stated that this code was available for proprietary funds. We should have been more specific. It's available for internal service funds. It is unavailable for enterprise and fiduciary funds, but is available for all other funds. Since this is a general purpose code, it is only available for our cities, towns, and counties. So if you are a special purpose district that needs to pay a judgment or settlement, you would still use your functional code for that expense. Same with our cities, towns, and counties that need to record a judgment and settlement in their enterprise funds. They would use the functional code for their enterprise. On the revenue side, the 36940, which is also called judgments and settlements, so make sure you are on the right side of your transaction. I messed that up before on my side. I was going too quick and just searching and put a revenue when I needed an expense, so do watch that. The revenue is available for all government types and all funds except those 600 funds, because those are other entities' funds, and therefore they would record their own judgments and settlements. Operating and non-operating. If you were not aware, we have a matrix of codes that are operating, non-operating, or that could be either depending on your government's operation. We hadn't updated that for quite some time, and we've had new standards and new codes come into existence since we last updated, but that matrix is now updated and it has correctly the operating, non-operating, and the in-between codes. If you were not aware of where to find that, if you go to the BARS GAAP Manual, Chart of Accounts, the second page under that Chart of Accounts tab is determining operating, non-operating revenues, expenses, and proprietary funds. That first paragraph, the second word is matrix. That is actually a link to an Excel spreadsheet that lists all of those BARS codes and what they can be classified as. So we are on to our third code word, which is SAO. All right, another thing we're really excited about, come December, we are creating and posting a new resource that will have the complete BARS chart of accounts by code and what funds those codes can be used in. I do want to put forth a word of warning that this resource is the complete chart of accounts. So every BARS code that the auditor's office has will be on this spreadsheet. If you are a government that has a specific entity type chart of accounts, so your chart of accounts is narrower than the complete chart of accounts, you will want to download your entity specific chart of accounts and do a crosswalk to ensure that you are only trying to use codes available to your government type. To make this a little easier, we are going to put this on the BARS export page, so the same page where you download your chart of accounts. So here's where to find that, BARS GAAP Manual, Chart of Accounts. The first page is the BARS account export. If you scroll towards the bottom, there's a blue box to download your chart of accounts for your entity type, your basis of accounting, in this case GAAP, and whether you want it above prescribed or just prescribed. And above that box, it might not be directly above, but in that area above the box will be the new resource. We'll make it very easy to tell that that is a downloadable spreadsheet. So it's one stop for you to download both to perform your crosswalk. Moving on to our notes to the financial statements. The last couple of years, we have, as an office, had a blanket requirement for all governments in Washington to report a COVID-19 note. Going forward for our 12/31/22 year end, if your year end is in June or August, this note will still be required for you until probably next year, but for our calendar year end governments, that blanket requirement is being removed. We are now requiring governments to take a look at the continued impact of COVID-19 on their governments and to see if there is still a significant impact to your government. Remember, GASB requires you to look at both positive and negative effects on your government. Positive effects could be a new revenue source that extends or expands your available services to your citizens, or a revenue source that allows you to improve your current services to your citizens. A negative effect would be if you run an event center and now you do not have the same amount of revenue. It has significantly lowered due to COVID-19 restrictions. That's an example of a negative effect on your government. So, telecommunications note, as we move forward into this electronic virtual world, more governments are allowed by state law to provide telecommunications services. Nowadays, we're seeing that in either wholesale broadband services or retail broadband services. In the past, only our PUDs could do that. Now it has been opened by the legislature to the cities, towns, counties, and PUDs. We have expanded the PUD note for those governments who can now provide it and choose to. And what that note requires you to do is to list your operating expenses and revenues and your standard expenses and revenues for your telecommunications separately, because the legislature wants you to show that you are not using your ability to levy taxes to subsidize and lower your rates for broadband services to the point where you become the only provider with a decent rate, since private providers cannot levy taxes. So that will be expanding as we move forward. We also have heard about governments wanting to use debit cards. In our state, there is a legal requirement that all governing bodies must approve expenses before they are transacted. Debit cards can remove that approval. It's very easy to expend before you get the approval. So for your general purpose of your government, you cannot use debit cards. But we have instances where you already have an approval. For example, you have a petty cash account that your governing body has already stated can be used for office supplies. In that case, you could be able to use a debit card as long as you have a strong internal control environment that lowers the risk of fraud. So we will be updating our 3.8.8 Impress Petty Cash and Other Revolving Funds section in the BARS Manual to address the use of debit cards for those types of funds. So looking to the future. I know we've implemented pension plans and OPEB years ago. We've all wiped it from our minds as much as possible. But we have heard from governments that they are starting to enter into new agreements with their employees that could qualify as OPEB or pension, depending on how the agreement is generated. So we want to remind governments, if they are looking for this, that they do need to look at the pension and OPEB requirements, and they could all of a sudden have a implementation of pension or OPEB. So that's our reminder about implementing after a standard. Just watch what you are entering into to see if that is a possibility. We also, for 2023, have subscription-based information technology arrangements, also known as SPIDA. Olivia is going to cover that in a little bit of detail in the second hour. So if that's new to you, you may want to stay for that second hour. We also have public-private and public-public partnerships and availability payment arrangements, which is commonly referred to as PPP. Those are also in 2023. So let's launch our fourth poll. All right. Are you responsible for filing the SAO annual report? Just a few more seconds here. And let's close that poll. All right. Most of you at least have a hand in the preparation of annual report filing. And this is what we've been seeing throughout our BARS updates. Moving on to future updates, we do have GASB 100 and GASB 101. GASB 100 is accounting changes and error corrections. It is creating two new categories for prior period adjustments. So changes in accounting estimate will be added and changes in reporting entity will be added as prior period adjustments with disclosure requirements. This is for fiscal year 2024, reported in 2025. So what we will be doing is updating the accounting and reporting guidance for those sections of prior period adjustments. You will also be getting new BARS codes for those two new categories. We'll have more information next year as we work through that standard. Our next standard is 101, which is compensated absences liability. This is for fiscal year 2024, reported in 2025. Currently, our guidance for compensated absences is very, very vague. We get a lot of questions every year on how to calculate that liability. Now with this GASB, we will have more detailed directions on how to calculate that. I will say it is very policy heavy, so the calculation is going to depend on your government's policy. So we will be adding a whole new section in the BARS manual for compensated absences and how to report and calculate that liability. Currently, all of that is in the Schedule 09 instructions. It's not the best place for the detailed instructions, so we'll be moving it over to its own section. As you may know, GASB always encourages early implementation. If you are looking at early implementing compensated absences, I will warn you that it very much ties to GASB 100 and tells you to follow GASB 100 during implementation, since we do have an accounting change in the standard. So this is the first time they have called to GASB 100 for an implementation. So if you implement 101, you're probably going to want to implement 100 at the same time. On to our fourth code word, which is update. All right. for our next quick update. BARS code 31130, which is sales of taxable property, will be removed for fiscal year 2023. The reason for this is we reviewed the RCW tied to this code, discovered we have codes already in existence that better explain what exactly is happening in this transaction per the RCW. So we will be removing that code, the 31130, and now we are going to specifically state that if you sell property, it should be coded to the appropriate 395 code. And if you collect property taxes on foreclosed properties when you sell them, it would still go to the 31110 code, which is our property tax code. So those two codes better explain the transaction than sales of taxable property. So we are moving to those codes for these transactions. Now I'm going to pass it on to Olivia to discuss the schedule of liabilities.
Thank you, Christy. So we just have a couple of reminders for you on the schedule of liabilities before we go to our first break. Our first reminder is to please do not report any negative amounts on your schedule of liabilities. This past year, with a lot of our pension plans having net pension assets instead of net pension liabilities, some people thought that you were supposed to report the net pension assets as a negative amount on your schedule of liabilities, but that's not true. The only thing you would report on your schedule of liabilities is those plans that actually have a net pension liability. Our other reminder for you is when you go to select your debt code, first make sure you're selecting from the correct category. So we have a few different categories you can choose from. We have general obligation debt, revenue, non-general obligation debt, and assessment debt. Now, general obligation debt is debt that you have pledged the full faith, credit, and taxing power of your government. So that means if you couldn't make those debt payments, you would actually raise taxes within your legally allowed limit. That way you can make those debt payments. But if you are not pledging the taxing power of your government, it automatically falls out of that general obligation debt category. And instead, you would want to use probably that revenue and non-general obligation debt category. Our next reminder for you is about the coding for landfill and post-closure liabilities. We've noticed that some people are using the environmental liability debt code. I know that landfills sound like they're an environmental liability, it's closely related, but we do have a specific separate code for any landfill and landfill post-closure liabilities. So my recommendation to you is just to go to your schedule of liabilities, reporting instructions, take a look at all of the debt codes that are available to you, and just make sure you're choosing the one that is the most appropriate for the debt you're reporting. Our last item there is for conduit debt. Now, conduit debt is debt that you have issued on behalf of someone else, and that someone else is going to be making the debt payments. You do not report conduit debt on your financial statements as debt, and you do not report it on your schedule of liabilities. It just goes in the notes to the financial statements. But if you have made an additional commitment or a voluntary commitment to make payments on behalf of that other person in the instance they're unable to make payments, that could potentially be a liability. And so if you get to a point where it's more likely than not, 50% or more likely that you are going to make payments on that someone else's debt, then you have a liability. And that liability is just measured at the present value of the payments that you think you're going to make. So if you have that, you would report that as a liability on your financial statements and also as a liability on your schedule of liabilities. And if you do have that, we did not create a new code for this. Instead, you would just use the miscellaneous liability code on that schedule of liabilities. Now here's what we're going to cover. We're going to review some of those basic lease concepts. And then we'll talk specifically about the BARS codes that you need for your Schedule 01 and your Schedule 09 or the Schedule of Liabilities. And then we'll look at specific examples of how your financial statements will change and what your notes to the financial statement should look like. And then we'll end the day by talking about those software leases, which is SPIDA. So let's start out with those basic lease concepts. I'm sure most of this section will be a refresher for you, but I do just want to cover some of those really important items. Let's start with the timing. We've been talking about leases for years now because the implementation was delayed. However, the time is finally here. For our calendar year end governments, leases are effective for you starting January 1st, 2022. So hopefully you're already accounting for leases under the new rules. If you're not, it's not the end of the world, but it might just be a little bit trickier for you to make sure that all of your leases are reported correctly by the end of the year. Now, before we get too much further, we have our next polling question for you. So we have a lot of lease information for you. Have you visited our SAO Leases project page? A lot of answers coming in. I'll give you just a couple more seconds here. All right, we'll close and share those results with you. So a lot of you haven't gotten to it yet. I highly recommend the page. It has most of what you need to implement leases. And if you have questions on leases, that also has some frequently asked questions on there, so you might be able to answer your question there. Here's our lease definition: a contract that conveys control of the right to use another entity's non-financial asset as specified in the contract for a period of time in an exchange or exchange-like transaction. I just want to highlight a couple of the important items in this definition. The first one being that the definition specifies we're talking about leases between two different entities. That means leases within your government are not changing. For example, if you have an internal service fund that leases equipment to other funds within your government, you're not changing how you account for that kind of activity. The other thing to keep in mind are that leases are for a period of time, which just means you don't have to worry about changing how you account for indefinite leases. I know some governments have things like indefinite easements. And the last piece I want to point out here is that a lease is for an exchange or exchange-like transaction. In government, sometimes we run across lease contracts where the payment is only $1 a year or $10 a year, but those are non-exchange transactions. So we don't worry about those with this lease accounting. Now, hopefully at this point in the year, you've already identified all of your lease contracts, but if you're still working on that, I just want to remind you that the contract doesn't have to be called a lease to meet this definition. So you might have a contract out there that doesn't use the word lease, but it meets this definition, and in that case, it should be treated like a lease. Next is the lease term, and this is really important. If you don't figure out the correct lease term, then that'll throw off the rest of your lease calculations. And your auditor will probably be taking a look at the lease term just to make sure it's calculated correctly. What do we include in the lease term? That first bullet point is pretty easy. We're just going to include any non-cancelable periods. But a lot of these contracts include clauses about either extending the lease or terminating the lease early. So what do we do with those? When we're talking about extending the lease, if it's reasonably certain that the lease will be extended, then you're going to include that additional time in your lease term. Now, reasonably certain is not absolute certainty, and it involves professional judgment. You'll need to consider the facts and circumstances at your own government to make this call. A couple examples of things that you could consider to help make this determination are, is this a really good deal so there's an incentive to continue the lease? Or has this lease historically been extended? Or are there other options where this item can be leased from? Or is this really the only option, so it's pretty likely that the lease will be extended? There's lots of other factors that might impact your decision. It's totally okay to use other items in your analysis. Those are just a couple examples. Now for the termination clauses, I like to think of this one in terms of an example. So let's imagine we have a lease that's a 3-year term and our lessee has the option to cancel after 2 years. If we're reasonably certain that termination option will not be exercised, then we're going to include all 3 years in our lease term. But if we do think that it's likely it'll be terminated, then our lease term will only be the 2 years. Now, our lease term always excludes periods if both the lessee and the lessor have the option to terminate, or if the lessee and lessor have to agree to extend the contract. Those are called cancelable periods, and we don't include them in our lease term. I also want to review the definition of a short-term lease. A short-term lease is one that has a maximum possible term of 12 months or less, including options to extend the lease. So let's take a look at an example. So a lease has an initial non-cancelable term of 6 months with 5 options for the lessee to extend for 12 months at a time. The lessee is a startup company and it's unlikely the options will be exercised. Is this a short-term lease? No, this one is not a short-term lease because when we talk about the maximum possible term, we don't care about probability. Those options to extend are always included in the maximum possible term, which means our maximum possible term for this lease is 5.5 years. Now, when we talk about the lease term for our accounting purposes, that's where we care about probability. And we decided it is not reasonably certain that those options will be exercised. That means our lease term for accounting purposes is only 6 months. So the determination of whether or not something is short-term and the calculation of the lease term are 2 separate things. So start out by determining, is it a short-term lease or not? And then your next step is, if that answer is no, it's not a short-term lease, then you calculate the lease term. It is possible to have a lease where the lease term is less than 12 months. So that brings us to our 5th CPE code word, and this one is cookies. Remember to write these down in order to make sure you get CPE credit. This new lease standard changed how we think about leases altogether. We used to separate them into capital leases and operating leases, but we no longer do that. So you probably know if you have a contract that transfers title of the asset at the end of the lease, we previously called those capital leases. But that term capital lease is going away. We're now going to use the term installment purchase or financed purchase. But we have some contracts that have bargain purchase options or purchase options at the end. So what do we do with those? Well, if your contract automatically transfers ownership, you treat that like an installment purchase or that financed purchase. But if there's the option, so it's not automatic, then you're going to treat your contract like a lease. And then your lease term is going to exclude the period after you exercise the purchase option. So basically what that means is the date that you purchase that asset, that's the end of your lease term. It's important to select a good discount rate because that impacts your present value calculations. The discount rate used really should be the rate that the lessor is charging the lessee. That might be stated in the contract, or it might be implicit in the contract. But if it's not, or you can't figure out the implicit rate, then you're allowed to use the lessee's incremental borrowing rate. And for lessors, you can use your own incremental borrowing rate if it's not practicable for you to use the lessee's rate. Now, the incremental borrowing rate is the rate of interest that a lessee would have to pay to borrow funds over a similar term, for a similar dollar amount, in a similar economic environment. What that means is that it would not be appropriate to select one incremental borrowing rate and apply it to all of your leases. A 50-year land loan would have a really different interest rate than like a 5-year car loan. So we would expect a 50-year land lease to have a different incremental borrowing rate than a 5-year car lease. Now, this incremental borrowing rate is an estimate. So that means that two reasonable people could sit down and figure out an incremental borrowing rate, and they might have slightly different rates, but they're both based on reasonable assumptions. So your auditor is not going to look at your discount rate and say, oh, wow, you used 2.5. I really think you should have used 2.4. Your auditors are not going to independently calculate these rates. Instead, what your auditor is going to do is take a look at your process and assumptions for selecting discount rates. And this should start with some specific piece of observable information that your auditor can review or confirm. So for example, if you're using interest rates that are published on like a local bank's website that lists out the different loan rates that they have for different types of loans, if you use that, then print off that sheet and write the date on it and save it for your auditor. What your auditor is going to be looking for is any unreasonable assumptions or information. So for example, is the information that you used from a long time ago, or are you using current information? They'll also be looking at things like, is your incremental borrowing rate actually a borrowing rate and not an investment rate? So for example, it is not appropriate to use the LGIP rates because those are investment rates, not borrowing rates. So now we're going to recap the accounting for this, starting with our lessors. For our lessors, it is the exact same in your modified accrual and your full accrual funds. There's no difference. So at the start of the lease, you're going to debit that lease receivable and credit the deferred inflow. And that lease receivable is the present value of future lease payments. And then your deferred inflow is the lease receivable plus any upfront cash that relates to a future period. An example of that is receiving the last month's rent upfront. So you can see that your deferred inflow might not always equal your lease receivable. So don't just assume that they're the same because they might be a little different. And then throughout the lease, as you receive payments from your lessee, you'll be debiting cash and crediting lease receivable for the principal amount of the lease payment. And then you'll also have an interest revenue for the other portion of the payment. Now you recognize lease revenue as you amortize the deferred inflow. And that has to be done in a systematic and rational manner. But GASB doesn't tell you what method you have to pick, so you can choose the straight line or effective interest method. Whatever you do, I recommend that you document your choice and that you're consistent amongst your leases. Now for the lessee accounting. For our lessees, it is different for you between your full accrual funds and your modified accrual funds. So we'll start with the full accrual accounting. At the start of the lease term, you'll record a right to use intangible lease asset and a lease liability. That lease liability is just the present value of future lease payments. And that lease asset is the liability plus any prepayments plus any costs necessary to get the asset into use. So that could be like shipping costs or installation costs. So again, your lease asset might not be the exact same amount as your lease liability. Then throughout the lease term, you'll be amortizing the lease asset over the shorter of its useful life or the lease term, and then you reduce that lease liability by the principal portion of your payments. Now in those modified accrual funds, so that's your governmental funds, you do not record a lease asset or a lease liability. Instead, at the start of the lease, you'll debit capital outlay and credit other financing source. And then throughout the lease, because you didn't record that lease liability or lease asset, you don't have anything to amortize. So instead, as you make those payments, you'll be recording a debt service principal and a debt service interest expenditure. Setting a lease threshold has been a hot topic. We've gotten several questions on it. I want to start out by saying that SAO can't tell you what your threshold should be. That's a management decision that has to be made at your government. But what we can do is provide you with these tips and tricks for setting a threshold that is hopefully appropriate for your government. So the first thing, don't just arbitrarily select a number, and don't just apply your existing threshold for capital assets. Instead, what we recommend is create an inventory of all of your leases, even the really small ones, and then use that as a guide to make sure that the threshold you select really is immaterial. And that means that each individual lease that excluded is immaterial. And it also means that if you add up all of the leases that got excluded, the total of those leases are immaterial. Now remember earlier when I mentioned that your lease asset and lease liability are not always the same, and for lessors that's your lease receivable and deferred inflow. Because those sides aren't always the same, when you're making these materiality or setting these thresholds, analyze both sides of the transaction, because if one side of the transaction is material, that means the whole lease is material and you should record it like a lease. This last step is really important. Keep track of all the leases that are excluded because of your threshold. Your auditor will really want to take a look at this. That way they can document in their own work papers that the leases that were excluded really are a small amount. And it's just a really good internal control for you to show that your threshold you've selected is appropriate for your government. Another thing that I would recommend is to periodically review the threshold if you choose to select one, and just make sure that it's still appropriate for the size of your government and the amount of lease activity that you have. Now that brings us to our next polling question. That should be launched on your screen now. True or false? Short-term leases are 24 months or less. All right, just another second or two before I close and share the results. All right, the results are on your screen. Most of you are correct. A short-term lease is a lease that has a maximum possible term of 12 months or less. Now we're going to talk about our Schedule 01 and the Schedule 09 BARS codes. We'll start with the lessor codes. So for your lease revenue, you're going to use either a 340 code, which is a charges for services BARS code, or you'll use 362. You're going to use that charges for services code when leasing is the primary operation of the fund. So in your proprietary funds, if it is an operating revenue, use the 340. If it's a non-operating revenue, use 362. And in your governmental funds, most likely you'll use 362 just because it's not normally the function of a governmental fund to rent items out. So most of the governmental funds will use 362. But if it does happen that you have a governmental fund that leases out items as a major activity, you would look at using a 340 code. Now for the interest revenue, regardless of whether you're using the 340 or 362 for the lease revenue, all of the interest revenue gets recorded to 361.40. Now for our lessee Schedule 01 codes, remember we account for leases differently in the full accrual funds versus the governmental funds. So in those full accrual funds, your proprietary funds, really the only expenses you have to report there are the interest expense and the amortization expense. So that interest expense gets charged to BARS code 592 with object code 80, and amortization goes to BARS code 501. In the governmental fund, because we're recording a capital outlay and another financing source at the start of the lease, we do have BARS codes for that. So the capital outlay is the BARS 594 with object code 60. And other financing source, you'll use BARS 391.70. And then as you make payments throughout the lease, you'll use your debt service codes. So that's 591 with object code 70 for the principal portion, and the interest portion goes to 592 with object code 80. You'll also need to know which codes to use for the schedule of liabilities. You'll see on the screen they're split between the two categories, general obligation debt and that revenue and non-general obligation debt. Now we covered the difference between these two a little bit earlier, but as just a quick reminder, if you did not pledge the taxing power of your government to make your lease payments, it is not general obligation debt. So for most of our governments, we anticipate that you'll use the revenue and non-general obligation debt codes. But because there's so many governments out there and so many different contracts, we don't know for sure that nobody has pledged their taxing power to make lease payments. So that's why we do have those codes available to you in the general obligation debt category, just in case that meets your situation. Again, most of you probably looking at the revenue and non-general obligation debt codes. So you see we have the two codes there, 263.52 for installment purchases. That is the same code we used to use for our capital leases. Really only the terminology is changing there. And then we have a new code, 263.57, and that's for your regular leases. Really, however this activity is classified on your financial statements, that's how it should be classified on the schedule of liabilities. And that brings us to our sixth CPE code word. This one is help desk. Okay, now we're going to talk about the reporting, specifically how your financial statements and notes will be impacted. Something I want you to remember as we look at these financial statements is that GASB does not prescribe what your line titles should be. So that means different entities' financial statements will look different. They'll call certain line items different things. I just pulled some of the common examples that we see. That way I could give you a visual of what we were kind of expecting here. We're going to start with the lessor statement of net position. And this is basically the same on your government-wide statement of net position and your proprietary fund statement of net position. If leases are a significant activity for you, then it would make sense to split it out into its own balance and report something titled like leases receivable or something similar. If lease activity is a really small portion of your activity though, you could just report this as a part of some other receivable balance. It's really up to your own professional judgment and what you think makes the most sense for your government. The thing that I want you to take away from this slide is that if your statements are classified, meaning you report current assets separately from non-current assets, then your lease receivable needs to be split out between current and non-current. Now, the other side of that transaction is your deferred inflow. Typically, we do see those deferred inflows broken out by category on the face of the financial statements. And I really wouldn't expect you to combine leases with any of the other categories, just because each category that is reported in those deferred inflows, the nature of them is so different, so it doesn't really make sense to combine them. So moving on to the lessor balance sheet, this is your governmental funds. Typically, we don't see these ones broken down between current and non-current. So in this statement, you might just have one combined lease receivable balance if leases are a significant activity. If leases are a really small activity, it might make sense just to combine it with one of your other receivable accounts. Again, the other side of this transaction is leases, and that probably would be reported as its own item in the deferred inflow category. Now let's look at the statement of activities. This is your government-wide statement. Your lease activity is going to be reported under the charges for services line on whichever function or program it's related to. Now, the interest revenue for the governmental activities should be reported under general revenues. So governmental activities interest revenue does not meet the definition of program revenue, which is why we have to spread it out into that general revenue. So if you do have leases in your governmental activities and you report that lease interest revenue under general revenues, you could create a new line that says lease interest revenue. But if leases are a really minor activity for you, it might make more sense to combine it with miscellaneous. So on the lessor statement of revenues, expenses, and changes in net position, this is for your proprietary funds. If lease activity is a major function, report it as operating. But if it's a really minor activity, just report it as non-operating. Now, GASB typically does not tell us what is operating and non-operating. It's normally based on your policy. But the one thing that GASB did determine is that the interest on lease activity is always non-operating. Even if that related lease revenue is operating, the interest has to be non-operating. So now we're looking at our governmental funds, statement of revenues, expenditures, and changes in fund balance. If leases are a major revenue stream, then you might list it out separately as something like rents and leases or a similarly titled line. Otherwise, if it's a really small amount, you could just toss it in that charges for services or some other similar line item. Again, it's really up to your judgment as long as it makes sense. Now, regardless of whether you report it in like a charges for services or have its own line, the interest revenue portion should be reported separately because it's a different component of the revenue. So if lease activity is a really big activity, you could put it in the interest on rents and leases. or if it's a really minor activity, you could just toss it in the miscellaneous category. Now we're going to look at the lessee side. We'll start with the statement of net position, and this is the same for our government-wide and our proprietary funds. Now, if your statement is classified, which again, that means that you report your current liabilities separate from non-current liabilities, then your lease liabilities also need to be split out between current and non-current. And then for your lease asset, if on the face of your financial statements, you report the separate categories of capital assets, so for example, land, building, equipment, then you really should have your own line for lease assets, because the nature of lease assets is just so different from those assets that you own. These are a type of intangible right to use asset. Now, I do not have a slide on the governmental balance sheet because we don't report a lease liability or a lease asset in our governmental funds. And that means the next statement we'll look at is the statement of activities for our lessee. This is our government-wide statement. You really only have the interest expense to report here. So for those governmental activities, you report that interest expense on that interest line with the rest of your interest. So the interest on long-term debt, just toss your lease interest expense in there as well. For business type, just report it on the appropriate line. So an example is if you're leasing a building in the water fund, then you'll report that lease interest expense on that water line. So the statement of revenues, expenses, and changes in net position. This is our proprietary funds. Really, you only have the interest expense to report here. So that would go in your non-operating revenues and expense category. You can just throw it in with all of your other interest expense, or if you think that it's important to your financial statement users to separate it out, you could potentially have one line called like interest expense on leases and interest expense on bonds. Again, totally up to you how you split it out. Now, this is the last statement we'll look at. This is the statement of revenues, expenditures, and changes in fund balance. This is for our governmental funds. So remember, we do not record a lease asset or a lease liability here. And that means that as we make our lease payments, we record that as debt service principal and debt service interest. And then for the lease issuance, you debit capital outlay and then credit other financing source. So that other financing source, you could call it something like lease liabilities issued or something similar. Now, I have a question here that's related to this slide. For the reporting year 2022, do we have to book a capital outlay and other financing sources for the leases that started prior to 2022? No, you do not. In your 2022 financial statements, you only have to book that capital outlay and other financing source for leases that are entered into in 2022. You do not have to go back through all of your previous leases and book those amounts. So that brings us to our next polling question. So did you know that the draft version of our BARS leases guidance is on the project page? We'll give you all just a couple more seconds here. All right, I'm gonna close the poll and share our results. So about half of you didn't know that was out there, so you learned something new today. On our project page, we do have the draft guidance that'll be put into BARS in December. We just wanted to provide that to you early, that way you have a chance to read over it and have that before December. Okay, now we're going to move on to talk about the notes to the financial statements. For our lessors, here are the main things that you need to include: a general description of the lease arrangement, the total amount of inflows recognized in the reporting period from leases and from variable payments not included in the lease receivable. So variable payments do not get included in that calculation of the lease receivable, but you do need to keep track of the variable payments that you receive in 2022. That way you can put it as a disclosure in your notes to the financial statements. Now, if any lease payments secure your debt, you need to disclose the terms or conditions that the lessee can terminate the lease or abate payments. And then if your principal ongoing operations are leasing assets, you would disclose a schedule of future payments broken down by principal and interest. So here's an example of what that might look like. I won't spend a ton of time on this. This is available on our leases project page. There's a description of the lease. They include the amount of lease revenue that they receive. And their table of future payments is broken out by principal and interest. Now let's talk about the lessee side. Lessee is kind of similar here. You're going to include a general description of the lease arrangements, the amount of assets recorded under leases and their related accumulated amortization, and that does need to be disclosed separately from other capital assets. So there's a couple ways you can do that, and I'll walk you through those two options pretty soon here. You also include principal and interest payments to maturity. Basically, that's the same table that you're preparing for your other types of debt payments. You're just now also going to prepare one for your lease payments. If you have any commitments for the leases before the start of the lease term, disclose that. And if you have any impairments, also disclose that. So here's an example of what that might look like. I won't spend a lot of time on this one because I want to take a closer look at disclosing the leased assets. But again, there's a general description, and that table of future payments is split out by principal and interest. So that takes us to our next code word. This one is FY 2022. Make sure you jot these down so that you can get your CPE credit. Okay, so this is the part of the note disclosure for lessees that I wanted to focus on. How do you report your lease assets in the notes? You have a couple options. This is our first option. You could include your leased assets directly in your capital asset note with all of your other assets. The important thing here is to remember that your leased assets should be on their own line. So for example, you can see that the leased buildings are reported separately from the buildings that the government owns, and that accumulated amortization on the leased building is reported separately from that accumulated depreciation on the buildings that they own. Now, if you had leased equipment or leased land, you would have separate lines for each of those as well. So that's option one. It would go just in your capital asset note. Now, option two would be to include your leased assets in your leases note. So notice this table here is only for leased assets. So it has a different line for buildings and equipment. If you had land or other types of leases, you would report each of those on their own line. So if you choose this option though, you're not done yet. You have that table in the leases note, and then you also need to include those leased assets in the capital asset note. Just in this case, instead of having a separate line for leased buildings, leased equipment, you just have one line for all of your leased assets. Now, the reason you have to include the total of your leased assets here, even though you have the details in a separate note, is because on the face of your financial statements, your leased assets are reported as capital assets. And this capital asset table here has to tie to the face of your financial statements. So if you left out your leased assets altogether from this table, that would mean your capital assets in this note would not tie to your financial statements. So 2 different options, you get to choose what you do. For the schedule of liabilities, this is only for the lessees. You'll add a beginning balance for leases that existed as of the start of the year. You report additions for new leases entered into during the year, and then reductions are those lease payments. In later years, as you have lease remeasurements, those will be reported as either additions or deductions, depending on whether your lease liability increased or decreased. Then your ending balance really should just tie to that lease liability that you reported on your financial statements. And that brings us to our last poll. Are you ready to implement leases? All right, give everyone a couple more seconds here. I'm going to close the poll and share those results with you. Oh, this is a pretty good division amongst the answers. A lot of you have already implemented. Congratulations. A lot of you are in the process, and a few of you are not quite ready. Okay, now we're going to spend the rest of our time together talking about subscription-based IT arrangements. I like to think of them as leases 2.0. Let's look at those implementation dates. If you have a fiscal year end of June 30th, that means that SPIDA accounting already started for you. It started on July 1st, 2022. Now, if you are a calendar year end government, that means SPIDA accounting starts for you on January 1st, 2023. So that's right around the corner for a lot of you. And similar to the leases accounting, we're really encouraging governments to be ready to implement at the start of your fiscal year. That way you can just record the transactions under the new accounting throughout the year. Let's look at the SPIDA definition. It's a contract that conveys control of the right to use another party's IT software alone or in combination with tangible capital assets as specified in the contract for a period of time in an exchange or exchange-like transaction. Hopefully that sounds really familiar to you because it's almost the exact definition of a lease. The difference here is that we're just now specifically focusing on that IT software. So let's take a look at a couple things that might be considered SPIDAs. Now, the reason I say it might be is because you really have to look at your individual contracts to determine whether or not they meet that SPIDA definition we just talked about. But we recommend you take a look at your cloud computing arrangements like software as a service, platform as a service, infrastructure as a service. Talk to your IT department to figure out if you have any of those contracts. Also take a look at cloud-based enterprise resource planning systems, so ERP systems or like your accounting software. Look at online conferencing tools. That's things like your Zoom or Skype or Microsoft Teams. Potentially even your email, calendar, and office tools like Microsoft Office 365. And even take a look at some of those online payment tools that you might use. Now, again, we say they might be SPIDA because you have to look at your individual contracts to make that call. Those are just a few examples of things that you can consider as you try to gather up your SPIDA inventory. So now that we talked about a couple things that might be included, let's talk about what is not included. The first one here is short-term SPIDA. And thankfully, a short-term SPIDA is the same definition as a short-term lease. If it has a maximum possible term of 12 months or less, including options to extend, then it's short-term. And you don't have to account for short-term SPIDAs under this new rule. In cases where the IT software is insignificant to the tangible IT asset, you would just treat that like a lease. So an example of that is a smart copier lease, where that copier is the tangible capital asset. Yeah, it has that IT components to it, but really that IT component is pretty minor. So just treat the whole smart copier like a lease. The other thing that's excluded are perpetual licensing agreements. Perpetual licensing agreements give you access to the software indefinitely, but the definition of a SPIDA is that it's for a period of time. So if you have a perpetual license, that is not a SPIDA. The other thing that's excluded are IT support services. So that would be like if you're paying for troubleshooting or help desk services, especially if you have that perpetual license and then you pay a separate fee for technical support, that technical support is not a SPIDA. So I have a question here. A lot of our software arrangements have online agreements and not a formal contract like for leases. How do you evaluate those for determining if it's a SPIDA? So when you're talking about like figuring out if it's a short-term SPIDA or calculating the SPIDA term, those are calculated based on the form of the contract. So if you don't have a formal contract and you're just paying like month to month or year to year, that would just be considered a short-term contract and it wouldn't be subject to this new accounting. So how do you account for these? Basically the same thing you're already doing for leases. So a regular SPIDA, you're going to record a subscription liability, which is measured at the present value of subscription payments, and then you reduce that liability as you make payments. You also record a right to use subscription asset, and that's measured at the liability plus payments to the vendor, plus capitalizable costs, and those are defined specifically in GAAP 96, minus any incentives. And then that just gets amortized over your subscription term. Now, if you have a short-term SPIDA, you just record an expense as payments are due. So how do you get started here? Read GASB Statement 96. You'll see a lot of similarities to GASB 87 for leases, but you're also going to see a few topics that are unique to SPIDAs. We also have a SPIDA project page that you can visit, and we have a link for that for you in the PowerPoint. And take an inventory of all of your SPIDA contracts. Include other departments in that conversation. And then you want to evaluate each of the contracts and document that evaluation, especially if you determine this does not meet the definition of a SPIDA or this is a short-term SPIDA. Keep your determination, document that, and that's really good evidence for your auditor to show that you did your due diligence in implementing this new standard. Lastly, we recommend everybody start testing, start calculating your SPIDA amounts. The sooner you get started, the sooner you can ask questions and make sure that you're ready to implement on time. Now that brings us to our last code word. This one is training. So before we go, we just have a few resources to share with you. We have a leases project page, and that one's been out there for a while. It talks about the accounting for leases. And the new thing that we've added to this page is the draft BARS page that's going into BARS in December. So we already have a leases section in the BARS accounting manual that's going to be updated with all of this new guidance. And that draft page is available to you so you can review it now. The other thing that we have is a SPIDA and PPP project page. So those PPPs are the public-public and public-private partnerships. Not a ton of governments in Washington have those. A few of you do. So the definition of those is on our project page. If you think you have a PPP, please feel free to reach out. We can work through that determination together. And the other thing that's on this new project page is a recorded SPIDA video. It covers a lot of the same information we talked about today, but it's already recorded and posted there for you if you want to refer back to anything. Now I have a couple of other resources to share for you. You can earn CPE with our on-demand training. So you can learn more about fraud. It covers an actual fraud case, and it talks about the best practices for internal controls. You can learn how to recognize the warning signs and red flags of common fraud schemes. So if you go to that QR code, it'll take you straight to the training. Okay, at this time, I don't see any questions that haven't been addressed, but if you think of any questions, please feel free to submit a help desk. We are happy to help. So here's our information for you. That is the end of our training. Thank you all for attending. I hope you have a great afternoon.